Hey, everybody, the market update desk, October 24th, Scott Riley, NMLS 157524. The end of the week, we've actually had a pretty stable week, which has really been pleasant as far as mortgage rates goes because we've had a very, very stabilized market. Tonight, we get the start of the World Series with the Dodgers and the Blue Jays. I'm rooting for the Blue Jays there. Lions have a bye week, and we get the big Michigan State rivalry. So, a pretty good weekend in sports coming up. Oh, and we had the NBA start of the season, and wow, did we have a bombshell yesterday with a betting scandal in the NBA. Let's talk business now. So we finally got the September CPI report. Showed that overall inflation rose 3/10 for the month, which was 1/10 cooler than what the market expected. Over year inflation rose from 2.9 to 3%, but that beat the market estimate of expecting it to come in at 3.1%. Now, one of the main reasons for the 3/10 reading was energy prices, which rose 1.5%. And that was all due pretty much to gasoline, which jumped 4.1%. We should get a little bit of reverse on that when we get the actual October CPI report, as a kind of a side note there. Core rate, which strips out food and energy prices, increased 2/10. And again, that was 1/10 lighter than the market estimated. Year over year core inflation declined, which was a good sign, from 3.1 to 3%. Shelter, which makes up the vast majority of inflation, 44.4% of the total core is shelter component. Now it's always important as it's such a big weighting. It's also the main reason that inflation was cooler than expected. Now, owner's equivalent rent, which has been a headwind, actually makes up 33% of that core percentage. And the most important factor of the total that rose 1/10, which was much cooler than the market figured, and we're starting to see maybe a little bit of shelter costs catch up with real time numbers that we've been hoping for. Now, we thought we might get this kind of come through, and we actually did, which was really nice. Now rents rose 0.2%, which would equate to 2.4% annualized. That also is much more in line with real time readings. Lodging away from home gave us a headwind, didn't help. That popped 1.3%, but this should be a component that helps us going forward, as there's been reports we've been seeing of cooling of hotel price demand. Now, when stripping out shelter, everything else in core rose only 0.11%. So in September, and 1.4% year over year. That's pretty darn good. If we continue to see owner's equivalent rent and shelter readings that are more in line with real time numbers, we're going to continue to make progress on inflation, and that's really good news. Now, this week, Tuesday, we get Case-Shiller Home Price Index. Wednesday, we get mortgage applications, pending home sales, and the beginning of the Fed meeting. Now, there's pretty much a 100% chance the Fed's going to cut 0.25%. It's going to be within the commentary and how the markets discern that. Now, we also obviously have the government shutdown, which adds a variable to all these components. Mortgage bonds this morning are continuing to trade in a range between support at the 25-day moving average and overhead resistance at 101.31. The 10-year Treasury is testing. It closed and held below 4%. Now that's creating a new top line resistance, which is good. And if we can get some movement with the Fed commentary and a little bit of help in the market, and yields stay under 4%, we're going to maybe test the 3.92% number on the 10-year. And if we do that, the next stop is 3.8. So we've got some positive movement going forward. That's great news for mortgages. We're seeing refinances start to come in more and more. We're seeing more buyers come in the market. I talked to a couple of my realtors this week, and we talked about why it's so important for buyers to get in the market now versus waiting till the spring. Maybe rates will be a little lower, who knows, quarter, 3/8, or it could be a little bit higher. The big thing, though, is we may see a little bit, let's say even 15% more homes in inventory because lowering mortgage rates incentivizes some sellers to do their move up. But while we might get 10, 15% increase in sellers, we could easily get 20 to 30% more buyers come back in the market. So that balance is going to be more out of whack than what it is right now. Give us a call. We'll run through how we can get you approved for a new house, work through our relationships to help get your offers accepted. If you're looking to refinance, it's a great time. Consolidate some debt, or get your rate if you bought in the last 2 years from maybe 7.5% down to low sixes, maybe even sub six if the matrix works right. Give us a call. We're working all weekend. 616-293-2189. The Market Update Desk, your original singular market news source for West Michigan. Let's have a great weekend, everybody. Take care.